Cost drivers are used to assign those overhead costs to cost objects. The cost driver should explain how that cost behavior works. We have 4 different types of cost drivers. We have activity-based, volume-based, structural, and executional. Activity-based cost drivers is when we use ABC accounting. So these are developed at a level of operations using activity analysis. Then our cost driver is determined for each activity. An example of an activity-based cost would be our number of machine setups, or the number of production runs, the number of inspections we have. Volume-based cost drivers are developed at a level of production. So they relate to the amount produced or quantity of service provided. In volume-based cost accounting, we can tell the difference because that cost driver and the total cost is linear. And what happens there is we might be able to produce 500 items for one cost, and then as soon as we go into 501, we step up to another cost. We have variable costs, fixed costs, mixed cost, and step costs. These were called stepwise costs in Principles of Accounting 2. So variable costs change in total cost associated with each change in the quantity of the cost driver or our product. There is a direct linear relationship between variable costs and our product. So for example, if we're making a car, we need 4 tires. If we make 1 car, we need 4 tires. If we make 2 cars, we need 8 tires, and etc. That's a variable cost. A fixed cost stays the exact same regardless of our output. Now what it doesn't say here is within that relevant range. We'll talk about that on the next slide. A mixed cost has components of both a fixed and a variable component. Mixed costs are very common in utility costs, where we have a flat utility cost and then we pay a per kilowatt or a per gallon of water usage. Step costs vary with the cost driver, but they do it in steps. So in that last slide example, when I said we had an exact amount of cost for 0 to 500 products, and then as soon as we step to 501, that cost goes up. So it costs $500 to make 500. As soon as we go to 501, that cost goes up to 1,000. And then at 1,001, it goes up to 1,500. That's a stepwise cost. Costs are linear within our relevant range. What the relevant range is when we're looking at fixed costs, is the range of production in which fixed costs do not change. We generally set up fixed costs with the use of contracts or legal agreements. We have yearly salaries, yearly rental agreements, mortgage agreements. So fixed costs are usually set for long periods of time and don't change on a day-to-day or production basis. However, there always comes a point of production at which we would need to increase fixed costs. So when we talk about fixed costs remaining exactly the same and unchanging, that is within a relevant range of production. So that means within a certain level of production, that range has a linear relationship. And so we refer to it as the relevant range. And when we're working in cost accounting, we stay inside that relevant range so we can use the information. We don't look at the outliers. in our accounting information. So we have this example here of total fixed costs. They stay the same across these units of, and then on the last slide, we have our total costs. So our total fixed cost is $3,000. And then we start adding our variable costs, which increases in our level of production. We see here our total costs, fixed costs, we have 10,000 units of output or 20,000 units of output. The fixed cost does not change between those two levels of output, but our variable cost doubles as our output doubles. The more items we produce, the less our fixed cost per unit becomes. However, our variable cost per unit remains the same regardless of how many units we produce within a relevant range. Structural cost drivers help us with our strategic decision making. They involve plans and decisions that have long-term effects. These are capital budget decisions, making decisions about adding new technology, scaling our production, adding a lot of complexity, getting new machinery, etc. Executional cost drivers facilitate our operational decision making. These are our short-term effects. This might be workforce involvement in the design of the production process. So one of the things that factory management discovered many, many years ago is that involving the workers who were actually part of the production helped them design better production processes. So the workers had good ideas about how to make their work more efficient. We can also increase our supplier relationships. We might have a supplier that's closer to us that we can set up a automatic shipments with so that we never run out of items. We'll see in a later chapter that running out of items increases costs. So another cost classification are products costs versus period costs. Product costs are only the costs necessary to produce the product in manufacturing or to purchase and transport any merchandising inventory if we're a merchandising company. Period costs are all of those other costs that aren't part of the individual product. This includes the selling and administration costs. So the selling and marketing of a product is a period cost because it's outside of that manufacturing, or even just purchase and transport if we're a merchandising company. So we see the merchandising versus manufacturing step here. So when we're a merchandising company on the right, we purchase merchandise for resale. We get that merchandise in, it becomes part of our product inventory, and then when we sell it, it is a cost of goods sold. Manufacturing has more steps. We start with direct materials purchases. That becomes materials inventory. Then we requisition those materials into production. We add materials to our production, labor and overhead to start creating work in process inventory. When work in process inventory is finished, we transfer that to finished goods inventory. When finished goods inventory is sold, it becomes an expense on our income statement. That is cost of goods sold. This is an example of T accounts within the manufacturing and merchandising. So you can see on the merchandising inventory, we have beginning inventory, inventory in and out, ending inventory, and then our cost of goods sold. The manufacturing process is more complicated as we have materials, labor, and overhead that we move to work in process inventory. Then work in process inventory gets transferred to finished goods inventory, which eventually gets transferred to cost of goods sold. We have a lot of information in our cost management system. So we need to look at characteristics of this information. Accuracy. We need it to be accurate. We need to be monitoring our internal accounting controls and making sure that we're keeping track of everything that we have. We have the timeliness. The timeliness can sometimes make us sacrifice accuracy. And then we have the cost and value of information. So the cost of information should be monitored by the management account to ensure that costs do not outweigh the associated benefits. So this is one of the main things that we talk about in cost accounting, is that the cost of recording and finding the information should not be more than the benefit of knowing that cost. This is how we end up with so much information in that indirect category or overhead, because trying to measure and control those overhead costs outweighs the associated benefits of knowing that. So we spend our time instead on allocating those benefits. So in Chapter 3, we talk about all of the different kinds of costs and cost classifications they are. We move on to Chapter 4. We're going to move into cost management systems. We're going to focus mostly on job costing in Chapter 4. We'll talk a little bit about process costing and activity-based costing, but they each get their own chapter.